So slightly different agenda for today than for most of our webinars. Typically, we do a deep dive into one subject in particular that we find very interesting and have a lot to share from our research. This time we go for a more generalized approach. So essentially, we're seeing a lot of trends unfold in crypto and within DeFi that we have been investigating in depth and are very excited about. And so this is a more general approach, diving into 4 or 5 of these key areas that anyone should be paying attention to. And we have a lot to share. So let's get started. Before, a quick update about Into the Block. As you guys know, we launched our Into the Block Perspectives product. Um, we are launching now one dashboard per week, giving very unique insights into some of the key verticals within crypto. So the idea with these is to make them very comparative, so we can have comparisons of the top derivatives protocols. This is the one we're launching today. You can see here like the volume over time. We actually hit an all-time high monthly volume in January with like very strong beginning of the year with the ETF. Some key metrics to compare perpetuals protocols. So very interesting. We also launched one for bridges, comparing the performance of bridges. What's the volume trading from one chain to a chain? Inflows and outflows is capital, leaving one chain, entering the other, comparing the tokens. And also for collateralized debt position stablecoins. So like MakerDAO, DAI, Aave, Go, CRV USD. We track the whole ecosystem, which has been growing over time and rebounded quite nicely in Q4. So the idea is for people to be able to dive into these insights. I'll be sharing throughout the presentation some of these findings related to the webinar itself. First, the first topic for today will be about bootstrapping mechanisms within crypto. Many of these can be used for fundraising or essentially bootstrapping their protocols. They're very similar, two sides of the same coin. So let's talk about how those have evolved. Firstly, I think it's a very important pattern to note out that crypto has been historically fueled by new creations of fundraising mechanisms. So we essentially, as an industry, since it's not very regulated and it's operating in a gray area, have come up with unique mechanisms to be able to fundraise. This starts with ICOs, and following the Ethereum ICO, and then the projects doing ICOs on top of Ethereum. They essentially enable teams to fundraise capital globally from anyone that wants to invest initially, creating just a white paper and a website, convincing people to invest in their token. This, of course, brought forth a lot of risks and a lot of projects that didn't materialize. So the industry evolved from that. In the following cycle, we see the rise of other mechanisms to bootstrap protocols. Namely, we see yield farming as an alternative. This one isn't really a direct investing opportunity, but rather, you provide your capital, you get a distributed token for being rewarded for doing certain actions, like giving liquidity to a protocol. And then we also have NFT mints, which are slightly more closer to ICOs in the sense that there's a team providing a roadmap and giving them essentially a chance to buy their token. Like the main difference from an ICO is that that token is a picture, a JPEG. So essentially, you get something in return right away. And oftentimes, if it doesn't materialize, you get access to a community and some extra perks. And this meta has evolved in the current cycle. We see IEOs, which were already from a few years back, but continue to operate now, and IDOs within DEXs. These are also, like ICOs, very much under their regulatory scrutiny. So they limit the amount of protocols that can raise these funds. as well as they limit the amount of people that can enter. So usually the US investors. And projects in the past few months, like Say, have been taking this approach to launch their token, as well as I believe Sui. In terms of airdrops, this is more of a retroactive mechanism to reward OG users and protocol's target audience. In a way, it also helps bootstrap the protocol, and it acts as the token generation event that essentially is the equivalent to an IPO, but where users are rewarded instead of the developers themselves. And more recently, of course, we have seen these metas unfold, and points really become the dominant paradigm in terms of bootstrapping. Of course, protocols like Eigenlayer being the main programs behind this. And this is different than an airdrop because instead of being retroactive distribution, it's continuous. And it's not really a token, but a proxy that essentially rewards people for doing a particular set of objectives, which can also evolve over time. So I created this, very concise way of summarizing all of these methods based on a given set of variables to compare them and contrast them. So essentially, with ICOs, you would be giving a direct investment into a team. They can do whatever they want with that capital. So you're not guaranteed to recover your initial capital. In a way, they are ruggable. They are not dynamic. They are not retroactive in nature either. And I also want to talk, more in depth about airdrops and points, which are somewhat similar. These usually don't involve direct investment. You get to recover what you put into the protocol. In most cases, barring a rug pool where people have access to funds that they shouldn't have, which shouldn't be the case, of course, if it's like audited. The point systems are a lot more dynamic, so they allow for fast iteration, which is why some people have been favoring them over just retroactive airdrops. And they also reward future use of the systems that developers create rather than retroactively. So because of all of these features, I guess, it's why points have proliferated in the past few months, and I think are likely to continue doing so through the bull market. Then we see as the second key, narrative unfolding, the rise of micro primitives. This is a term our CEO, Jesus Rodriguez, coined. I see Susana raised her hand. We do have questions at the end. I know I'm going a bit fast, but feel free to ask some questions in the chat. I have a look here, and we'll have a Q&A at the end. So going back to micro primitives, this is essentially a trend that we have been noticing within DeFi, where protocols are moving to provide smaller, in a way, more minimally expressive protocols at the base layer, and create that as the base infrastructure for more customization to be built on top. The idea with this is essentially to enable a broader set of applications that might not be able to be imagined, and also be more resistant in a way to be able to handle all sorts of different innovations on top of a base layer. And for that to be successful, they need to be unopinionated protocols. And essentially what they do is they outsource the computation to the layer on top. I know this sounds like a lot of jargon, so I'll give an example that very clearly shows this. So Uniswap, before they launched their white paper like almost 6 months ago, and the main item here that stood out was the creation of Uniswap hooks. This essentially hooks allow custom logics for almost anything to be deployed in Uniswap, both from the trader side and the liquidity provider side. So users will be able to have a broad array of functionalities essentially that they weren't able to have before. You can think of this like as a very broad set of if and then functions that people have access to. like for instance, limit orders, which right now are not possible. Dynamic pool fees, you can think of reasons why it makes sense for fees to vary when markets are more volatile versus less volatile, or when there's like a depegging event, the fees should also move accordingly. So this will create a lot more dynamism and feedback loops within these pools. It also allows, hooks also allow things like time-weighted average price orders, where you can, buy over time, sort of like dollar cost averaging, and even do the same for providing liquidity. So time-weighted AMM, where you supply liquidity given a set of criteria that you can define. This, of course, is very complex, or can be complex for the average user to take advantage of, which is why Uniswap v4 hooks are essentially the base layer for Uniswap X, which is the aggregator on top, which is able to route orders through all of the different, core infrastructure pieces created in Uni v4 hooks. And what they do so through intents, which is the other, key language here. And this has been getting a lot of buzz because essentially it's a way to create a competitive market where people submit intents to fill an order, and the most competitive order wins out, which in turn results in better execution for the end user without them even knowing all of the hooks and layers that are below it. I hope that makes sense. I see some comments in the chat. I'll get into them towards the end. Someone's asking if we're recording the webinar. We are. So we'll be sharing that in our social media later. Now, we're seeing the same trend of microprimitives emerge within lending. So Morpho Blue and Euler V2 are the key innovators within the space. And it's very similar architecturally to Uniswap v4, in the sense that, for instance, Morpho Blue has isolated lending markets at the very bottom. And this is like a wide array where you can create any market permissionlessly. So you can have any token that you can imagine, borrow another asset with a given set of criteria. That doesn't really mean that there will be people providing capital to it, which is why there's a risk layer on top called Metamorpho, where people distribute capital based on a given set of risk criteria, that there's entities above that specialize to be able to, manage those risks and provide the best risk-adjusted rewards to the suppliers and borrowers on top. So it essentially expands the horizons for the broader lending architecture. We're also seeing microprimitives expand beyond applications into infrastructure, with risk-taking being a key part, which I'll get into more detail later. And in governance, also sub-DAOs being able to have like more independence within the organizations. So like MakerDAO and Spark, where Spark is a lending protocol that takes advantage of the Maker ecosystem, namely DAI and other applications that will be built, to have like a somewhat independent governance while being still benefited from being part of a greater ecosystem. Now, I want to talk about app chains, rollups, and layer threes. So in the last bull market, 2020, 2021, we already had the ability to create layer ones and the ability to make those app specific. So Cosmos in particular has been, the market standard for creating layer ones on top of the Cosmos SDK. This allows more sovereignty and adaptability for people creating their own custom layer ones. So you can think of it instead of having NFT fees, NFTs like increased fees during the past bull market, or liquidations affect your application. These layer ones have their own separate ecosystems just for their applications, where you're not really subject to other parts of the chain creating bottlenecks for you. So it creates that independence, that sovereignty that allows apps to have more flexibility. And it also allows stakers to validate a wider range of applications that you might not be able to do in other layer one blockchains like Ethereum or Avalanche or Solana. DYDX before has been the pioneer here, launching late last year their perpetuals exchange. It's fully integrated. They have their order book on chain that stakers validate, and it's all on top of the Cosmos SDK, which allows them to have a more integrated approach where they can manage a lot of the parts of the stack while also giving lower fees to users. Maker actually is exploring similar plans down the road with Solana, a Solana app chain. Another key infrastructure unlock that is helping applications to be in DeFi a lot faster and more efficient are the evolution of this, or the creation really of the sector called rollups as a service. There's several providers within this space like Conduit, Dimension, Outlayer. These allow essentially anyone to spin up a roll app or a generalized roll up very quickly. And what this allows is for essentially any app to have their own ecosystem within seconds. I have a quick demo from Conduit, no affiliation, but just to see how quick it is. You select what chain you want to deploy, where you want to have your data availability, and within a few minutes, you can have your own chain live. This approach has quickly grown. It started around last summer, but we really see this accelerated in Q4. So the first example of this is Aevo. Aevo was initially called Ribbon, and they did a pivot towards a perpetuals and options protocol that's not on mainnet, but rather has their own infrastructure set. And they essentially leverage Conduit, which is one of the RAS players that I mentioned, to have the OP stack, so the Optimism, essentially a fork of the Optimism mainnet that's independent to them for their rollup. That Optimism layer itself is validated and relies on the Ethereum security for essentially the execution layer. And for the data availability layer, that is validated by Celestia, which reduces their cost by 99%, which in turn translates to no gas fees for users. And that is itself provided by the Cosmos SDK. So I know this is a lot of infrastructure jargon, but really what this enables is the creation of more competitive markets. So by having this infrastructure, gone are the days where people would have to pay $100 in gas fees to make a simple transaction. In Aevo, you can pay like 0 gas fees. Essentially, you just need to bridge into the rollup and then you're good to go. And it allows the DeFi protocols to be a lot more competitive than what they were just a few years ago. A slightly different turn on this architecture is what Arbitrum is opting for. So while Optimism is essentially scaling horizontally, creating multiple layer 2s, Arbitrum Orbit is going vertically. They are doing L3s, layer 3s, on top of the Arbitrum 1 layer 2. And there's a reason, in my opinion, why they do this, which is that they are the leader, objectively in DeFi. They have 68% of the volume between the main optimistic rollups. They have 70% of the TVL. And this allows the layer 3s on top to take advantage of that liquidity and DeFi advantage while having greater speeds and lower costs for fees in a layer 3 than they would in a layer 2. So I think this is just getting started, but over the next few months, we should see more layer 3s develop and launch. Then let's talk about real world assets. This was a bit of a buzzword in Q3, Q4, as people started realizing ways to bridge off-chain assets, so traditional assets, on-chain. arguably before Q3 and Q4, stablecoins were already, a real world product in the sense that they bring fiat capital on chain. And what the main unlock has been for RWA in the past few months has been treasuries on chain. And this has become relatively standardized. There's multiple players in the ecosystem that provide 5% APY for anyone that want to hold stablecoins. And it's more competitive than just having your value decay with inflation. Here, right now, you are actually beating inflation, so it's a better alternative. And interestingly, it also creates a floor for DeFi yields. So before these were integrated across crypto, the yields in DeFi could vary very significantly from like 0% to 20%. And in the bear market, as tokens crashed and there was no demand to borrow, the rates to borrow were like 2-3%. But after the RWA treasuries began to be integrated in DeFi, we essentially created a floor of 5% across the board, because people would have that easy arbitrage opportunity where, if power rates in Aave are 3% and you can earn 5% in SDAI, which earns 5%, you would be able to arbitrage that rate, which essentially moved that up and created that floor for DeFi yields. That being said, you can think of 5% in treasuries as an interesting product in a bear market where everything is trending downwards and you get to preserve your capital. But to be frank, as market conditions evolve, this becomes less interesting. You're actually already seeing maker real world assets start to decline here based on our data. So I think this sector is likely to continue to evolve during the bull market, where we might see tokenized ETFs. So people are getting access to Bitcoin ETFs right now. There's the potential play to integrate those as well as other ETFs in a way that you have like an IOU and entity validating those. Of course, it's not fully permissionless, as is also the treasury market, but it creates a greater flexibility to, for instance, borrow against those ETFs. So that could be an interesting product to watch out for. Tokenized stocks as well, as these are at all-time highs. Real estate is more complex, but I think if not in the next few years, in the next 10 or so, we're most likely to see real estate also on chain. And we're seeing the rise of tokenized compute, which I notice is not DeFi per se, but it's a brand new category. People are calling it DePIN, decentralized physical infrastructure, where people are able to provide their servers to essentially contribute to AI computation, and has been one of the sectors getting more traction out of the real world. Lastly, I want to talk briefly about the transition from liquid staking to liquid restaking. So liquid staking has been arguably the sector within DeFi that has held up the best during the bear market. They continue to grow in TVL even during 2022, when the market was crashing. This accelerated in 2023 after the Chapella fork made withdrawals available for people staking on Ethereum's Beacon chain. So we see here that spike accelerating the amount of ETH staked through liquid staking. And in the past few months, we see a slight reacceleration with layer twos like Black using staked ETH, I believe also Mantle, and more importantly with EigenLayer, which has managed to attract, I think, over 1 million in ETH. So that's like 2.5 billion into liquid staking protocols. And that is, I think almost undeniably the next trend that is shaping up to be massive within crypto. So what EigenLayer does is essentially it expands the scope of Ethereum. Right now, Ethereum validators can validate transactions basically within the Ethereum ecosystem. and not much more. Eigenlayer enables the creation of actively validated services, which is essentially any other type of application you can imagine that takes advantage of the Ethereum security. So they call this a market for decentralized trust. And you can think of it somewhat as a parallel to Cosmos SDK, where they create the base layer for people to spin up their own chains. People with EigenLayer can create their own applications, but in a way they're validated by Ethereum. Sort of, I don't know if people are familiar with Cosmos. It's like the interchain security that they provide with Cosmos zones. And it allows those applications to already bootstrap their liquidity in a very quick way, and also validate other things that are not in the scope of existing Ethereum validation. And essentially, since this scope can be very broad, there is a middleware created, which is called the liquid restaking ecosystem. And these essentially aggregate all of the AVSs that are building on top of EigenLayer. They give yields from each protocol to the end user, and they abstract away the complexity from all of these applications that are leveraging Ethereum's underlying security. So we're keeping this essentially this section short and sweet because that'll be the main subject for the next webinar. But before that, a few conclusions. DeFi is evolving very quickly, crypto in general, and it's taking shape in multiple directions. In the most broad way, the meta has essentially shifted from fundraising or bootstrapping protocols from like liquidity mining to points. Points enable a lot more dynamic and iterative approaches to bootstrapping, and they also give more flexibility to the protocols. So we're seeing this really take off and bring more people into the space as more protocols are launching tokens and rewarding early users. So that's one key narrative that has been shaping over the past few months and will continue to do so. We are also seeing in parallel a lot of changes in the ways that DeFi protocols are thought out. They're becoming more minimally expressive base layers, more akin to the internet like Web 1 protocols, where they're less opinionated and allow applications to be built on top. But really, the protocol itself is more decentralized and trustless. We're also seeing the significant infrastructure advancements, as I mentioned, from rollups and layer 3s in particular. Those are allowing DeFi to finally be competitive with CeFi products. And I think this will materialize in DeFi getting larger market share from CeFi counterparts. And this is just beginning to unfold, so I think it'll most likely accelerate this year. Real world integrations have been growing significantly. They might reshuffle a bit because, as I mentioned, 5% rates are okay in a bear market. In the bull market, those rates are likely to go down as treasuries decrease, and it's likely to pivot a bit to other verticals within real world assets. And finally, we're seeing EigenLayer and restaking in general evolve the scope of layer ones, which we're just seeing the glimpse of that, but we're seeing very large growth, over 6 billion in EigenLayer. And I think that's going to be one of the key narratives to watch out for next year. So sign up for the next webinar. That's going to be about restaking. You can sign up there. We have been doing a lot of collaboration with restaking protocols and are active in the space. So make sure to sign up for that one. We will have some key insights that are perhaps not as obvious and very interesting for anyone within crypto. So make sure to sign up now. I know I rambled a lot and perhaps a bit quickly, but I'll be sticking around for some questions, which I imagine you guys may have some